Hello, everyone. This is Mike Eklund with Financial Symmetry, here today to provide a third quarter 2020 market update. The purpose of this is a quick 10 to 15 minute summary of what has happened in the financial markets over the last quarter. Since we want to keep it quick, I'll move forward to our first slide, which is from a legal disclaimer perspective, is just telling everyone that the material has been prepared for informational purposes only and should not be used as investment advice. One thing I want to remind folks on the listening here is that if you are an existing client of Financial Symmetry, please contact your advisory team if you have specific questions on your portfolio or performance. Moving forward to our first slide of content is actually the world stock market performance over the last 12 months. So what the slide shows here is that at the end of September 30th, 2019 to the end of September 30th, 2020, the world stock market was actually up about 10% over that time period. Now, obviously, it didn't go in a straight line as we saw a lot of things happen over the last 12 months, including obviously a large drop in the stock market in February and March due to COVID. Obviously, record rise in unemployment claims, as I've highlighted here in red. But then a quick follow-up to that surprised many was the U.S. stocks closed out their best quarter since 1998 in the second quarter of 2020. So we've seen a big drop. We saw an increase, a big drop, and then a rise again. But in net, the world stock market has been up about 10% over those last 12 months. Moving forward to our next slide is one that I really enjoy. It just shows that over the long term, and this is looking at the world stock market from 1970 to 2019, the markets have rewarded discipline. So if you would have invested $1 in the world stock market in 1970, at the end of 2019, that would have totaled $69. So what happened over those approximately 50 years? A lot. For example, in the early 70s, we saw the S&P 500 down by about 43% during 1 year. We also saw inflation over 13%. We had Black Monday in 1987, which was a one-day drop of 23% on the Dow Jones. We had the dot-com stock crash in the early 2000s. We obviously had the global financial crisis, which saw the S&P 500 down about 46%. Additional items such as Brexit, fiscal cliff worries, but the reality is the stock market continued to advance. And that's the thing I wanted to remind folks on this slide is that there's always a reason not to invest. But for those who stay disciplined and look beyond today's headlines, see the long-term benefit of investing in the global stock markets. All right, so what happened in the third quarter of 2020? So what we saw was that the US and emerging market stock markets were up about 9%, which is obviously very strong for one quarter. We saw international markets developed up almost 5%, and then bonds up about 0.6 between US and international bonds. And that's kind of what you typically see from bonds. When you see a strong stock market performance, at least high quality bonds, you'll typically see a lower performance, and then vice versa, as well as when stock markets underperform, typically high quality bonds will do better than the stock market. So that's a quick summary of what happened in the third quarter. But taking a little bit of a longer view, our next slide here looks at the performance of the U.S. and international stock and bond markets really over the last 1, 5, and 10 years. So just a few things I wanted to note on the page here is that over the last year, positive returns for stocks and bonds, except for real estate. Obviously, much better returns for U.S. and emerging markets than international developed, but still positive across the board. I have highlighted a couple items here in red, just noting the extremely strong performance we saw in the U.S. stock market really over the last 1, 5, and 10 years. Over the last 10 years, up about 13.5%. So, 10 years ago, it was interesting because it was very common for people to ask, why invest in U.S. stocks? Because the reality was the previous 10 years, and we'll have a future slide, will show a little bit more on this. Actually, the US stock market had very poor performance, actually had negative performance over the previous 10 years. So, but obviously that did not come to fruition the last 10 years with very strong US stock market returns versus very low returns in the international markets. 2.5% for emerging market stocks, which we'll show in a slide in the future, was actually the best performing market the previous 10 years. And then the bond market between 3 to 4%, depending on if you're investing in US or international bonds. So that's the summary for the kind of the last 1, 5, and 10-year performance. Moving further, I'm actually recording this on November 9th, so it's shortly after the election. And obviously, some people are happier or upset, depending on their views of the outcome. But I think the summary of this slide is just showing that from 1926 to 2019, the stock market performance did not differ materially between presidents, either if it was Republican or Democratic president. And although I don't have this on the page, if it was a Democrat or Republican Congress, had the similar results. Now, Financial Symmetry over the last month or two has done blog posts, podcasts, and actually a recent recorded webinar that's all on our website if you want further information on kind of how to think about your portfolio during an election year. So moving forward, as I mentioned on the previous slide, I think it's important to note the benefit of diversification. I think a lot of folks may think, given the strong performance of the US stock market the last 10 years, that it only makes sense to invest in US stocks. But many forget that the previous 10 years, and that would be the 2000s, from January 1st, 2000 to December 31st, 2009, as we noted on the slide below here, that large US stocks actually had a negative return. That's the lighter colored bar here. Large growth stocks in the US actually had about a negative 4%. That's annualized. That's not total, that's per year, a negative 4%. Now compare that to how the US stocks did the last 10 years, and you see that, depending on the type of stocks, large, small companies, growth companies, value companies, returns were, kind of anywhere from 11% to 15% for large US growth stocks. So many may think that, hey, it only makes one place to invest is large US growth stocks, but the reality is the previous 10 years was a much different outcome. Now, on the flip side, as we talked about on a previous slide, emerging market stocks kind of are the flip of how the US stocks have done. So if you look at the light colored bars here, and that was during the 2000s, you see that emerging market stocks had much better performance than US stocks during the 2000 time period. But during the last 10 years, the 2010s, you see that emerging market stocks have trailed not only US stocks, but developed ex-US stocks as well. And a particular note there is emerging market value, which was the best performer during the previous 10 years, is now been the worst performer during the last 10 years. And so that's just an example of the benefit of diversification. The way I like to describe it, if there's something in your portfolio you don't like, it means you're diversified. So, those emerging market stocks, more recently value stocks, have probably not done well versus the exciting US growth stocks like the FANGs. But the reality is, in the short term, it is impossible to predict the winner or who's going to do the best. And the best thing is to have a globally diversified portfolio. Moving forward to our next slide is another common question and topic that we get from folks lately. And it's primarily related to what we call the FANG stocks. And so those FANG stocks are Facebook, Amazon, Apple, Netflix, and Google. And the summary there is, since they've done so well recently, is why not just to invest in these stocks? What's the benefit of a diversified mutual fund or ETF or global stocks? Because those stocks are so strong and have done so well, they are probably the best investment to use going forward. Well, this slide actually looks at the largest 10 US stocks at the start of each decade. So in 1930, the top stocks were AT&T, General Motors, General Electric, and shows how that list has changed over time. A couple things I'll note. You'll note here on the page, which I find very interesting, is how quickly and how much the top 10 lists change from decade to decade. For example, personally, I started my career at General Electric in 2000, and they were, one of the top 10 stocks on the list. I think number two at the time. It was viewed that there was nothing go wrong. Jack Welch was running the company. 10 years later, it moved to about number 10 on the list, and now 10 years after that, it's nowhere to be found. So that is the risk of just investing in those 10 stocks. You think about the 2000 time period. That was also a time period where we saw the tech companies do very well, similar to today. You had companies like Cisco, Intel, and Lucent, which are no longer on that top 10. And so that is one thing to keep in mind, is that what looks like the great company today is no guarantee it's going to be the great company in 10 or 20 years ago. In addition, one thing I did not include on this slide, but there's also research that shows, is that once a company is included on this top 10, their returns over the next 10 years are about 1.5% less than the rest of the stock market. So just a summary there is obviously performance is very strong to make this list, but once it's on it, performance going forward, going future, going is actually lower than what we've seen in the past, or versus the stock market in general. All right. Moving forward to our next slide, we have a couple left here. As I mentioned to begin with, we want to try to keep this short and right to the point. It is a return forecast. So we don't have a crystal ball here at Financial Symmetry, but we have found that the price you pay is a good predictor of future returns. And so these are actually the 10-year return forecast as of June 30th, 2020 from Vanguard's market perspectives. So this is not our specific forecast, although we have similar views to them, but this is actually coming from Vanguard. And this is their expectation on per year returns for the next 10 years. So what I've done is I've highlighted a couple things in red here. The first one is U.S. equity. So they're expecting U.S. stocks to return between 3.9 to 5.9% over the next 10 years. Now, you want to compare that to, I think, about the 13.5% return received the U.S. stock market had for the last 10 years. It just shows you that we call mean reversion, how things can go up and down, especially in time periods such as 10 years or less. In addition, areas of the market that have not done as well, such as value stocks, are predicted to do better than just U.S. equities in general. And growth stocks in the U.S., which have done very well, and we just talked about the FANGs, are predicted to do actually worse than just the stock market in general, at about 1.6 to 3.6% per year. And then finally, you may ask, what part of the market is expected to have the highest return going forward? Well, I've highlighted it here below, but it is global equities ex-US, which is international stocks. So they're expecting international stocks to return between 7.4% to 9.4%. So you can see how that works in terms of, we saw in our previous slide that the last 10 years have done very well for US stocks, but the expectation is going forward would be a better place to invest internationally, given the higher expected return. But the final thing I just want to note is that although returns for US stocks or stocks in general are lower than historical levels, they still are expected to be higher than what we expect in the bond market and in the cash and bond market as well, expecting returns kind of in the 1% to 2%, depending on the level of risk you take in the bond market. All right. So wrapping up, I just want to leave with a few remaining thoughts. The first thing is, although we are updating this, and I appreciate you listening to this webinar, no one can consistently time or predict the markets. So it's obviously helpful to be knowledgeable of what's going on, understand that, what you should be doing is really focusing on what you can control. And that's things such as having an investment plan and having it implemented. And that's what we do here at Financial Symmetry, is we help our clients implement a well-diversified long-term investment plan based on their financial goals. In addition, focus on things such as how much you're saving or withdrawing from your portfolio versus your plan. And then finally, obviously tax efficiency as well, because that's important to kind of, you spend after tax dollars, not pre-tax dollars. So focus on as being as tax efficient with your portfolio as possible. In addition, with questions, as I mentioned, if you are a financial symmetry client, I highly recommend reaching out to your advisory team if you have any specific questions on your portfolio or strategy. If you're not an existing client, I've included our contact information here below. We have financialsymmetry.com, where we have a lot of information in terms of blog posts, podcasts, YouTube channel. Um, in addition, I've included my contact information if you have specific questions on the presentation or our approach to investing in general. But in summary, I just want to thank everyone for listening. As I mentioned at the beginning, we plan to do this every quarter, so I hope to speak to you in a few months. Thank you.